Despite the slowdown in the world economy, inflation has been higher, and this is not normal at all. It is predicted to increase by 0.9 percentage points in advanced economies and 0.8 percentage points in emerging market and developing economies, respectively. Additionally, a longer-term increase is anticipated. And at the same time, the CDO of ARK Invest, Cathie Wood, advised us to be very, very careful. Why is there so much chaos about it? Is something big going to happen? Stay tuned to know what this legendary investor has to say. So let's get started. The possibility that the conflict in Ukraine will completely cut off Russian gas supplies to Europe, that rising prices will result in widespread food insecurity and social unrest, and that geopolitical fragmentation will make it more difficult to promote international trade and cooperation. Inflation could be stubbornly high if labor markets continue to be unduly tight, or if inflation expectations are overly optimistic and turn out to be more expensive than anticipated. When GDP data is announced at the end of August, following the 1.4% fall witnessed in the first quarter, we may discover the U.S. economy is already in a recession by that definition. Here, one crucial indicator, according to Cathie Wood, shows that the Federal Reserve's interest rate increases have brought the U.S. economy dangerously close to a recession. The only issue is that Fed officials are choosing to ignore the data. Furthermore, the yield curve is more inverted now than it has been since the early 1980s, when double-digit inflation was entrenched. The yield curve explains how the rates on U.S. government bonds with various durations or maturity dates relate to one another. Short-term bonds often yield less than long-term bonds. An upward sloping curve could be seen on a graph. The yield curve inverts, however, when this correlation is broken and short-term bonds start to pay out more than long-term bonds. And that's what's taking place right now. The yield on the 2-year Treasury was 4.32%, whilst the yield on the 10-year Treasury was only 3.5%. The Federal Reserve identifies yield curve inversions as excellent forecasters of recessions, but it also cautions that they're not perfectly associated and the exact relationship isn't fully known. Since 1957, every recession has been preceded by a yield curve inversion. The projection predicts that growth in the U.S. will be 2.3% this year and 1% next year due to decreased household purchasing power and tighter monetary policy. With COVID-19 outbreaks and lockdowns, China's downturn has been worse than expected, and the negative repercussions of Russia's invasion of Ukraine are still being felt. Additionally, growth in the Eurozone has been downgraded to 2.6% this year and 1.2% in 2023 due to the effects of the Ukraine war and stricter monetary policy. Amid worrying signs from the bond market, U.S. Treasuries rose and Asian markets slipped lower today. Fears of a recession were evident in the bond market as demand for longer-dated securities pushed this week's severe yield inversion below that of 2-year notes by the most since the early 1980s. The depth of the inversion and its persistence for such a long time, according to Wood, make it more of a red flag for the Fed in the current century than it was in the early 1980s. Since early July, the yield curve has been inverted, and there is currently an 80 basis point difference between the yield on 10-year and 2-year Treasury bonds. A decade later, the Fed raised interest rates amid concerns about excessive stock market speculation. The Great Depression then came after the Great Crash. And here comes the renowned internet investor has spent the last year arguing that the Fed is wrong to raise interest rates, even if inflation is still close to a 4-decade high. Wood asked the Fed to change course from its ongoing cycle of rate hikes, claiming that the economy is demonstrating signs of lessening inflationary pressures. We wouldn't be shocked if broad-based inflation begins to decline in 2023. But there is no sign of that. The Fed could slow the pace of its rate hikes, according to Fed Chair Jerome Powell, who has warned that the struggle against inflation is far from done. The lower peak interest rate has been priced in by the market as a result of Powell's remarks, according to Fed Funds futures data released. Further, according to futures, the terminal rate will be 4.419% in December 2023. Wood claimed in a series of tweets that the present economy is similar to 1920 when the Spanish flu, World War I, and supply chain snarls drove inflation beyond 20% before it sharply fell the following year. The Roaring Twenties, or a decade of economic expansion, were ushered in thanks to the Federal Reserve's decision to cut interest rates at the time. Cathie Wood acknowledged that she had vastly overestimated the severity of inflation before asserting that the U.S. economy is probably now in a recession. Wood attributed the higher-than-expected inflationary pressures to supply chain disruptions and geopolitical issues, such as the conflict in Ukraine. She added that a recession that was partially caused by poorly managed inventory had already started. The University of Michigan survey's measurement of the decline in consumer mood was another indicator that a recession had already started. Wood is alluding to the rise in stockpiles at stores like Target and Walmart in recent months as a result of Americans changing shopping patterns. It's a situation that might indicate a slowdown in American consumer spending, which accounts for nearly 2/3 of the country's GDP, as well as ongoing supply chain problems. The supply chain problems that caused so many headaches for businesses during the pandemic have taken more than 2 years to start being addressed. She was also taken aback by the war in Ukraine, which has only increased inflationary pressures like everyone else. Wood has argued for years that the true economic bogeyman is deflation, not inflation, insisting that deflationary tendencies, including technological advancement and a decrease in population growth, will cause consumer prices to plunge. She remains steadfast in her position. Fears of a severe currency crash haven't been felt since the 1997 Asian financial crisis resonated over the world due to the US dollar's spectacular climb, which has seen it hit record after record. Investors have flocked to the dollar as a result of the Federal Reserve's quick, sharp interest rate increases and the overall strength of the US economy, driving the dollar up and driving other currencies, including the British pound, Indian rupee, Egyptian pound, South Korean won, and others to previously unheard-of lows. Others, particularly developing market nations, are in a worse situation. In the past year, the Egyptian pound has fallen by 20%, while the Pakistani rupee has lost 29% of its value against the US dollar. All of those nations, as well as others like Sri Lanka and Bangladesh that benefited from cheap and ample liquidity during the pandemic, when interest rates were low, are now experiencing tighter global liquidity. Prices of raw materials are forward-looking indicators throughout the early phases of processing. Except for food and energy, most commodity prices have peaked and are currently declining year over year. Food and energy prices are crucial without a doubt, but we don't think the Fed should be battling and escalating the global suffering brought on by a supply shock to agricultural and energy commodities brought on by Russia's invasion of Ukraine. Manufacturers and merchants appear to be under siege from inventory buildup downstream. Even world-class businesses appear to have ignored their automated enterprise resource planning systems and placed excessive orders for goods after battling supply chain limitations for more than a year. Walmart saw its inventory rise by 25.5% during the most recent quarter despite only seeing single-digit sales growth. According to Nike's most recent quarterly data, the inventory discrepancies have gotten worse. Meg's stocks rose 44.2% internationally despite a 3.6% increase in sales. Its inventory growth in North America and aboard ships in transit was 64.8% and 85%, respectively. In the automotive industry, used car price inflation has indexed peak at 54.2% on an annual basis in April 2021 and made another run to 46.6% in December 2021, but have since fallen 13.5% year to date and are now down 0.1% year over year. Used car sellers who face inventory losses are likely to dump more inventory, which might severely depress price inflation. According to Cathie, the Fed is more worried about its legacy than the actual economy, who has been hinting about this for some time. Woods feels that warning signs of deflation have been disregarded, as was revealed in late June. She claims that the CPI, which Wood views to be a lagging inflation indicator, has been used far too exclusively as the basis for interest rate rises. Wood suggests using gold's performance as a more accurate inflation gauge. She notes that the price of gold shot up from $1,350 per ounce before COVID to a peak of close to $2,000 around 2020. Prices have since decreased, almost reaching the $1,700 level. Furthermore, concerns about cost-push inflation, like those observed in the 1970s, should subside over the next 6 months if inflated retail inventories and stock prices are representative of employment rates and earnings. If you are planning to buy a new iPhone, I would suggest you to focus on savings and investing. The future is really dark, so try to hone your finance skills and listen to the experts like Cathie Wood. But if you have any tips about surviving the upcoming recession, feel free to comment down below. Well, this brings us to the end of today's video. We hope you liked the video. If you did, make sure to hit the like button. And for more such informative videos, subscribe to the channel and don't forget to press the bell icon to never miss an update from us. We'll catch you guys in the next one. Until then, peace.